Today in InvestTalk, we look at rising healthcare costs in retirement. We cover the continued meltdown of large cap tech in markets. We answer questions about Las Vegas Sands, Starbucks, McDonald's, and more. And then at the end, I talk about why the end of Chevron deference could be bad for business.
This is InvestTalk, independent thinking, shared success.
Now, our main focus point today is about healthcare costs in retirement. And this is one of the most overlooked aspects of retirement planning. Definitely something that we hit on with our clients when we're building out their comprehensive financial plan. And because after housing and transportation, that is the next highest cost typically for retirees. Now, people who retire at 65 can expect to spend at least on average $157,500 through their life, through retirement on healthcare and medical expenses. And obviously, that number goes up every year because people are living longer. A lot of people are retiring before Medicare kicks in, and there's high rates of healthcare inflation. But you can do things like proactive planning. That's what we do for clients, cost management strategies, earmarking particular accounts for medical expenses, for example, getting supplemental insurance options, and that is an important aspect to always explore. But number one is always not underestimating, and most people do, right? Make sure you at least overestimate a little bit of what your what your healthcare costs are going to be. Now, Medicare covers many basic services, but there are a lot of out-of-pocket costs that can easily reach $5,000 per year or more. And it doesn't cover things like dental care, vision, and hearing services, for example. And often, and as you get older, those dental procedures, they often add up. Right, your teeth are older, and just naturally have more and more procedures, and so there's an additional $1,000 to $1,500 at least annually for insurance on those type of things. Then prescription medications. Luckily, people are using less of those, but it is the largest out-of-pocket cost for retirees typically, and you need to look at inflation of those costs, because we know drug companies continue to raise the price of the drugs that they offer, and so we always built in an inflation adjuster that each year increases. So, for example, if someone's retiring this year, we look at $25,000 to $30,000 annually for a couple in out-of-pocket expenses, and typically we index that to inflation. Now, then there's long-term care expenses. Now, everyone's different. You have to factor in your health, your age, your budget, determine what coverage you need. But remember, private nursing homes, that's $100,000 per year. Even at-home care can cost $50,000 or more per year. And that's always something you have to potentially account for. But it's important to remember that even though $150,000 sounds intimidating, it's not all at one time. It's spread out over time. So everyone's different. This is where, having a good advisor helps. Everyone is tied into robo-advisors. And I think for a lot of young people, not a lot of money, I think those can be good. They can be helpful. They can be guiding you in a general right direction. But as people get older, into their 40s and 50s, and then it starts, retirement starts to come, that you can see the light there at the end of the tunnel a little bit. And that's when you really start to hone in on these type of issues. So make sure you're not overlooking the healthcare aspect of retirement planning. 888-99-CHART, 888-992-4278 is how you get through and ask your question on today's show. Now let's take a look at the market today. It was another follow through from what you've seen over the past few weeks. I've been highlighting this for a while now, is this rotation in markets. And, part of it is the Fed easing cycle that's looks to be headed our way, as well as a Bank of Japan hiking cycle that is unwinding the yen carry trade. And that is causing those that are executing that to sell off certain positions, and a lot of them are selling off their tech names. So that's part of it. In addition, you have I'm looking at the heat map for today. Nvidia is down 15% over the last week. Google down 6.25%. Microsoft down nearly 5%. Let's see what else. Other big movers. Tesla's down 12% over the past week. But just today, it was mainly Nvidia, right? Nvidia down 7% today, and you continue to get that unwind in markets. Broadcom down 4.5% today. What were the other big movers? Even Procter & Gamble down. Tesla down 4% today. So it was a very interesting day because if you look at small and mid caps, they actually had a decent day. Small caps are up about 0.25%. Mid caps are up about 0.75%. But large cap growth, once again, getting kneecapped, as I said over the weekend on my YouTube video, kneecapped by the yen carry trade or the unwind of it. Large cap growth down 1.5% on the day. Really, really rough day there. You had some earnings after hours as well. Microsoft down a little bit, not recovered kind of later in the after hour session, but that was interesting. And tomorrow we have Fed Day. So market reaction to that will likely create more volatility. Now, that could be volatility to the upside, right? Where we are, I would say, oversold to a degree. Okay. So if you look at the S&P, let's go to the S&P cash, it was down 27 points today, right around the 50-day moving average, but it's been there for about 4 or 5 days. So one lesson here on technicals, when you sit at a support level for a period of time, it's just gaining power to break through to that next support level, which frankly would be right around 52, let's call 75 in that range, 52.80, and now we're at 54.36 at the close today. So I think that's likely as we head into August. Remember, tomorrow is the last trading day of August. And this new trend is unwind of just overly bullish positioning in large cap tech, especially in relation to AI. Anything that's AI related is just taking it on the chin because it's pretty clear. Remember, Goldman had that report a few weeks ago saying all this is, I would say all of it, most of it's hype. Right? There's all of this spending that's going into development of AI tools, and they have some features, some tools, right? It works to a degree, but is it the next coming of the internet? No, it's an iteration, it's a tool, but it's not driving the business outcomes that everybody had promised. And maybe one day it will. And one day it probably will. But as most things in that get hyped up, that people get excited about, the hopes and dreams of what that could ultimately be tend to be much farther into the future than people realize. And that's the case here with AI. And so that's the rotation you're seeing in markets. And I think it will continue through much of the second half of the year and into next year. All right, let's tackle this caller question.
Hey, Luke, I'm calling about Las Vegas Sands Corp, ticker symbol LVS. It's about 35% down for the year. Consumer discretionary stock that is in the casinos and gaming industry. Wanted to see what your thoughts are on a buy point at about $39.40. Got a little bit of a dividend. Thinking of picking up some at this price, but wanted to get your thoughts first. Thank you so much and love what you guys do. Bye-bye.
All right, looking at Las Vegas Sands, and yes, this is well off of its 52-week high, down 35% from its 52-week high. It peaked out back in, early part of 2023, about $65. Now we're at about $40, $39 and change today. Earnings expectations for this year and next year are continuing to drop, so that's an issue. And you're seeing that growth that was big in 2023 really dwindle. And earnings last quarter were up 20%, but revenues were only up 9%. And as we go into the back half of this year and into next year, earnings growth is expected to slow dramatically more. And so the relative strength is 12. So the chart is absolutely horrendous. And for everyone else out there, what Las Vegas does is, as the caller said, it's in the casino business, but it's heavily tied to Macau. And Macau, its business is tied to the Chinese economy. And we know the Chinese economy continues to slow. So, it owns Venetian and Palazzo in Las Vegas, but it also owns Venetian in Macau, Sands Macau, Londoner Macau, Four Seasons Macau, and Parisian Macau. And as well as one in Singapore, which that one I believe is doing well. But it's mainly driven by what's happening in China. And so that's why I don't see any reason to jump on it now. You're trying to catch a falling knife. This is extremely weak, and it mirrors the Chinese economy. And so I see no reason to get in. Historically, a fairly good performer, but that also is in a time when China was doing well. That's no longer the case. So it's not even on my watch list. I would take it off. Thanks for the call. We have a lot of ground to cover over the next 45 minutes or so. We have some other topics on the docket. Number one is gold prices. There's a new report from the World Gold Council and what is driving the record high prices in gold. Now, it was Asia, but now that's no longer the case. There's a new buyer. And guess what? It's more domestic. So we're going to look at that story. Also, there has been a recent Supreme Court case that overturned, not Roe v. Wade, but what is called Chevron deference. And this says a lot to do with regulation in government. And a lot of businesses are going to say they like this. But in reality, this actually could be bad for many types of businesses, and especially innovation, growth within the economy. So we'll look at that, what kind of ramifications that ruling could have on corporate America. So those are the things on the docket for me today. We also have voice bank questions in regards to Lumen technologies and buying credit card companies, and also questions that came in via our YouTube channel. And of course, your live calls at 888-99-CHART are always number one. And we're going to get to one of those right now, and that is West from Nevada. And you want to talk about profits?
Yeah, I've never heard you guys talk about your philosophy or strategy for taking profits.
Well, you always, number one, it's having a target price, a valuation where this is no longer cheap, that maybe the valuations are a bit rich. And at that point, you probably at least want to trim your position. That's typically what we will do, rebalance the position. And then at a certain point, if it gets, egregiously overpriced, then, and all of those potential, that potential growth is pulled forward. I think of NVIDIA right now. NVIDIA had all this, these high expectations built into it, and now that's kind of coming off, and it's pretty clear that they were never going to reach those levels of growth, and so if you ever get to that point and you own the stock, you need to have the discipline to recognize that. Now, on the downside, usually there are support levels. You could have a trailing stop. Sometimes we have that. We look at momentum in relation to the broader market, to that particular sector. And if it is no longer leading that sector, it's no longer performing well compared to the broader market, then that could also be another reason to take your profits. So that is a hard thing. Buying is easy. Everybody can go buy a stock. It's extremely easy to do that. But you're right. It's a great question because one of the hardest things is when to sell. And, most people, when things are going well, they don't even think about selling. They only think about selling when things are going poorly. And that's why most people do bad. They don't do well, right? It's because they don't have the discipline to trim when valuations get a bit rich. They don't have the discipline to sell when the technicals are deteriorating, right? They wait until things get really bad and, you can't take it anymore and emotions kick in and you sell at the bottom. And that's how most people sell. So great question. I love that question. And hopefully that gave you some insight on how to think about taking those profits. Thanks for the call, West. Now we're going into a short break. Please remember you can call anytime and leave your question on the InvestTalk voice bank at 888-99-CHART. Now, I hope you've been telling your friends. The podcast is in video form over on our YouTube channel. And let's check out a question submitted via the comment section. Carter Erickson says, I'm looking at Owens Corning stock. Do you like the company? And so what is the entry point? Well, it's an industrial name, so it's certainly bucking the broader trend of the big tech sell-off. $15 billion market cap. They manufacture building materials, glass fiber reinforcements for industrial, commercial, and consumer markets. I would say, yeah, I like it. $15 in earnings expected this year, 16 and change next year on a $182 stock. The technicals are just fine. It's a bit overbought near term, but nothing crazy, right? It's kind of been in this range here between 180 and 165 for a few months now, and now we're at 182. So I don't mind it. I think it has a solid balance sheet and good profitability. So I'm going to give Owens Corning a thumbs up. Now let's pivot over to a voice bank question from 888-99-CHART.
Hi, Justin and Luke. I'm calling in with a question on the stock Lumen Technologies. The symbol is LUMN. I've been a long-time holder and bought in to the stock a couple years ago at $11 and another at $10 per share, and now just wondering what your thoughts are on the whether or not to continue to hold the stock. One is in a retirement account, so that will probably stay for a while. Just wanted to see what your opinion is, and I'll be listening to your podcast. Thanks so much.
All right, looking at Lumen Technologies, this is a name that had great cash flow, but they had a tough balance sheet. And new management has tried to right the ship by selling off some assets and paying down the debt. And in some ways, they have been successful, but not to a level where the market feels really comfortable. You know, debt peaked around $37 billion. Now it's down to $18 billion. But once again, that took a lot of selling of quality assets, at many of them pretty good prices, but still, they weren't able to right the ship to where their cash flow can sustain their debt. Now, this recent earnings announcement, things got a bit better, but I think a lot of this is short covering. I still don't see kind of a light at the end of the tunnel here. Although the market obviously is pricing in a little bit better of a potential outcome. So, are you going to get back to even? Probably not. Unless they do right the ship completely, they get their balance sheet into a situation that is sustainable. But I don't see that quite yet. The technicals now look good, right? It was up big today, and I think it could continue higher in the near term. But it's probably a name you want to be selling at some point. But wait for a reversal pattern because it did just break out to the upside. So for a trade near term, I think it's fine. But I would probably be looking to sell it over the next 12 months. Now, in the next Invest Talk, we'll look into this topic. Understanding how to secure the best home equity line of credit rates is essential for homeowners. So that story tomorrow. But for now, I'm Justin Klein, ready to take your calls at 888-99-CHART.
Hi, InvestTalk. I had a question about buying into a credit card company. So Visa, MasterCard, or American Express were the three that were on my watch list. I know Visa just reported earnings and the stock has come down. It looks like close to a 200-day moving average. So my question is, do you have a preferred from those three company that you would allocate money towards? Or do you feel like it could even be good just to dollar cost average into the three of them evenly, not to some like super high weight in my portfolio, but just to have some exposure? I just see them as a, triopoly, and also with the expenses that the cards charge, it just seems like they'll always have like that income. I also was curious your take on American Express. I know they charge higher fees to merchants, but they also don't have as many people probably who qualify for the card just because it requires a higher credit score. If that has any influence on your decision, to my first question. I know that's a lot, but I'm very interested to see what you guys say. So I'll listen on the show, and thank you as always.
All right. Let me start off with saying that you have to look at American Express very different than Visa and MasterCard. And a lot of people think that Visa and MasterCard, the credit card companies, they are not credit card companies. They are payment networks. They're payment networks. Visa and MasterCard do not take any credit risk. Okay? They process payments. That's it. And they partner with banks to issue credit cards. American Express has their own payment network, but they also take credit risk. So in many ways, American Express is kind of a hybrid between a Visa or MasterCard and, say, a Capital One. Well, now Capital One is actually joining the ranks of American Express because they bought Discover, because now they have, same thing, a payments network along with taking that credit risk that they typically do. Now, there are other credit card companies out there that are pure lenders, and Discover Capital One used to be that. So you have to look at these very different. Here's my issue with Visa and MasterCard is that look at what's happening in crypto. Look what's happening with Zelle and Venmo. They're becoming more options, more payment processing options out there. And while Visa and MasterCard are still dominant, there's likely to be a more powerful new entrant with Discover or Capital One, right? Using the Discover payment rails and network to expand their market share of payments. And so I worry a bit about that. I think there's a lot of potential issues there. There's regulatory risk here. There's already been that with, what regulation has come down with debit card fees, for example. And, both sides of the aisle are becoming more populous from an economic perspective. And so I could easily see coming down there. So, and Visa and MasterCard, they trade at, pretty high multiples and pretty high valuations because they're quality businesses. But I do think there are a lot of risks there. And earnings for Visa and MasterCard are continuing to come down. So I actually like the companies like American Express or now Capital One that do a bit of both, right? You're taking the credit risk, and that is a very profitable business. And near term, while the economy is weakening a little bit, it's generally people have jobs, and defaults on credit cards are still relatively low, and consumer balance sheets are relatively healthy. And so I rather own something that has a lower multiple, like a Capital One or an American Express, over a Visa or MasterCard. So that's my take. And hopefully that gave you some clarity on that space. All right. Now let's talk a little bit about gold prices. And this is a new report from the World Gold Council. And it showed that private purchases of gold surged to 329 tons in the 3 months to June, so the second quarter, and almost 5 times higher than the previous quarter. Okay, almost 5 times higher than the previous quarter. And this created a total demand for gold of 1,258 tons in the quarter, the highest level in the second quarter since records started being compiled in 2000. And it was up 4% year over year. Okay. And gold price recently hit a record high of $2,483 per ounce. That was earlier this month. Now, the main driver of this demand are wealthy individuals and families and individuals, mainly worried about the rising level of government debt. And the Congressional Budget Office, remember that's an independent watchdog, says that U.S. debt will surpass its second World War high of 106% debt to GDP by 2029. Okay. And so it's pretty clear that the large wealthy investor is starting to say, hey, I can't just tie my entire future towards stocks or real estate. And I need to diversify a bit. And gold is that safe haven. Always has been. And frankly, it's under-owned right now. And I think there's a lot more potential for gold to go up because not many people have exposure. Right? It's kind of the opposite of the big tech names, right? So many people have exposure there. And it's not just here in the US where the demand is strong. Singapore and Hong Kong saw big pickup in demand from wealthy individuals. Same with the rich Turkish investors because the lira devalued dramatically recently. And so you have still high demand in the East and now strong demand here in the West. Now, Chinese consumers and investors did pull back a bit in the first half of the year, mainly because the People's Bank of China paused purchases in May. So despite that big buyer pulling back over the past couple of months, demand still remains strong. And flows into gold-backed ETFs turned positive just in the last few weeks. June and July had 5 consecutive weeks of inflows totaling 39 tons. And that's following 2 consistent years of selling. So that's what I'm saying. People are under allocated to gold. And so I think there's a lot more room to run. Central banks' net purchases have helped push the price up by a third since the start of 2022. And their demand hit 483 tons, a record level for the first half of a year. So, there are a few places where demand is slowing. China and, frankly, the jewelry market, which is natural, right? Prices go up. The cost of that jewelry is a bit higher. And so demand pulls back. But still, net, you have record demand. And there's, I would say, record under allocation, but very low allocation in most people's portfolios. So very interesting report there, and definitely gives more fuel to the fire of a gold bull market that I think we are continuing to be in. Now let's play another listener question now.
Hello, I just had a question today about a stock called Watsco, WSO. I wanted to find out, looking at their fundamentals before I purchase it, it's kind of pricey. It's trading at $503 a share. And I was just checking out the fundamentals. They look like a very profitable company. I'm looking at their balance sheet. It looks pretty much intact. I'm looking at their price to book is at a number 8. I want to know, before I pull the trigger, do you think is advisable to jump in at the cost it is at the moment? If you can please let me know, I appreciate it. Thank you so much for your help.
We're looking at Watsco, and the first thing, I hope when you were saying it was expensive stock, you weren't just looking at that dollar amount. Now it's at $481 per share. When this question was recorded, it was at $503. I think that might have been yesterday. So down pretty big today, down $22. But this is always a misnomer. You don't want to just look at the stock price that's expensive. This could actually be very cheap, trading at $481 per share. Remember, it's always in relation to sales and earnings, etc. Now, when you look on that basis, it is also expensive. You looked at price to book. That's one way to look at it. And it is trading near an all-time high level of price to book, around 8 times. That is very expensive for a name like this with relatively low growth. Earnings are supposed to be up 2% this year, 11% next year. It's a low to mid-single digits grower. And it's a large name, $18 billion market cap. It's very profitable, 19% return on equity, very little debt. I like that. But once again, as you said, the valuation, not because it's trading at nearly $500 per share, but the price to the underlying business metrics are trading at near all-time highs. Enterprise value to EBITDA, around 25, which is where it peaked out in 2021. Also, very expensive. So that's the issue here, is the multiples it's trading at are just way higher than they normally are. And you saw, I believe I would imagine there was earnings. Yeah, earnings. That's why it was down $22 today. Earnings were up 2%. Revenues up 7%. So, good quarter, but obviously the market didn't like it, especially with these multiples. It's going to have to really knock it out of the park, and it's really priced to perfection. And that's why you want to stay on the sidelines for this. So a good name to have on the watch list, but it needs to come down at least probably 30% from here probably below, say, 350, then I would think about picking up Watsco. But for now, I'll pass. This is InvestTalk. Let's play 2 in a row from 888-99-chart.
Great show, by the way. I'm a new follower on InvestTalk. If you get a chance, I'd love you to dive into the fundamentals of StarBucks and Kraft Heinz. I'd love to hear some of your feedback on those companies. Think about buying that for long term. Thank you. And my name is Brett.
All right, Brett. Well, glad to have you on board with InvestTalk. And usually I don't answer to, but I will, mainly because Kraft Heinz is fairly easy. Low growth name. It's not exciting to me. It's had history of accounting issues. The technicals are middling to poor. And I just see no reason to get in. Now, Starbucks, on the other hand, I think this is a durable brand. We actually recently started to pick it up here in the low 70s. And it actually had good earnings after hours. Let's see, where are we at after hours? Just go to another chart here. There we go. Up to 78 and change after earnings. And earnings were okay. Revenue's down 1%, earnings down 7%. But that was kind of priced into the market because it is down so much. And we were targeting this 75 level as a good entry point for Starbucks. So, earnings are still expected to go up, although those estimates are coming down for this year and next year. But once again, a lot of that is priced into the stock. And as you know, Starbucks is a great brand with one of the highest profitability metrics in the consumer discretionary space. Return on invested capital, is set 59%. Okay, which is near a record high. Things are slowing, but overall, it's still a very, very powerful business with very good cash flow. So if you're picking one or the other, definitely Starbucks over Kraft Heinz. Thanks for the call. Now let's tackle one more question from our InvestTalk YouTube channel. Derek Jones, 5219, says, I would buy McDonald's here, provided the dividend continues to grow because the bad news is just about done and built into the stock. Well, it sounds like that's Derek's opinion. We'll see. Let's see if I agree with that. Well, earnings did come out yesterday, and it reported definitely a quarter that, on its face, not so great. Okay, you had revenues flat, you had earnings down 6%, and the stock was up. And that is an indicator that, a lot of this is priced in. It's moved down from $300 per share back at the beginning of the year to a low recently of $243. Now it's bounced up to $264. And so, yes, I would agree with that. It was a lot of that negative sentiment was priced in, but estimates for this year and next year continue to come down. And, in a world that's more health conscious and you have pressure on wages, okay, due to demographics, due to higher minimum wage standards in places like here in California and elsewhere, I think there's pressure there. So, it's still trading at a mid, low 20s multiple, which is, a premium to the market. It's a low growth name with good profitability, but, it still doesn't get me that excited. It's not super cheap. And I think there's still headwinds to the business overall. So, I just wouldn't jump in with 2 feet here. Could you start to add a position? Sure. But if you look at enterprise value to EBITDA, for example, it's down from an all-time high in last fall around 22. Now it's down to 16. But where is the longer-term average? It's closer to the low teens, 12, 13. Okay? And so until it gets closer to that, I still don't think it's cheap enough to jump into McDonald's. So I like that it's on your watch list, but it's still not at a level that gets me jazzed up to add a heavy position. Let's just say that. It's about fairly valued. Thanks for the call. Well, we're headed to our final break of the day. And after the break, I'm going to touch on deregulation. It is a term that is often used within the political space, within Wall Street and in business circles. And sometimes it can be good for industries, but there's a recent Supreme Court ruling that pushes back on a lot of regulation. And so the question is, how good will this be for businesses? And one way to look at it is that it actually will be worse for businesses. I'm going to look at that as well. So that'll be next. But this is Invest Talk. I'm Justin Klein, and we have one goal here each and every weekday, and that's help you achieve your own version of financial freedom. And our work continues after this final break. So get your questions in now at 888-99-CHART. Now let's talk a little bit about regulation. And there was a recent Supreme Court ruling that shot down the 40-year-old precedent of what is called Chevron deference. And what this basically means is that that precedent forced judges to defer to government experts that do this every day, right? Are focused on this industry every day, when laws were ambiguous, that there wasn't a clear answer of how things worked. And many CEOs are applauding this and saying, this is going to cut bureaucratic red tape and pointless regulation. And they think that's going to create more efficiency and profitability. And certainly in some cases that may be true. But as most things, the answer lies somewhere in a gray area, because there's likely to be a part of the business arena that is going to say that they should have been careful what they wish for. Why? Because if these regulatory agencies are forced to spend more time defending their actions, what that means is they are going to likely take longer to approve things like building a power plant, launching an investment fund, approving, pharmaceutical drugs, because they're going to spend more time in court and more resources in court defending the things they've done in the past. And this will feed into likely a longer payoff period for investing in new endeavors, because it's going to take longer to get things off the ground. That's naturally how these things work. So, it already takes years to permit a pipeline, for example, or a new factory. And it's likely to get even longer now. Now, so CEOs are going to likely need to watch out for regulations by enforcement, and agencies such as the SEC have a long history of using investigations and fines to set new standards. And so, if it's harder to make rules, they're going to crack down on ones that they think that they can get through a particular lawsuit, for example, in court. So it becomes more tempting to use a case involving misdeeds to change an entire industry's behavior, right? So the crackdowns will be swifter and harder, okay? And so there's likely to be different rules in place. Federal agencies are no longer going to hold the sway that they once did. And individual judges might come to different conclusions. And you might see national standards struck down. And what would that mean is that you'd have a patchwork of regulations across the country, which makes it far less efficient to operate. If you're having to dodge rules in different states, it becomes harder. I can tell you that firsthand. In our industry, give you a little insight here, if you're under a certain threshold of assets under management, you have to be what is called state registered, and you're governed by state regulatory boards. And they might come and audit you, and every state has its own axe to grind and their emphasis. For example, back in the day when we were audited, you get randomly audited. We get audited by Washington, and Washington was focused on elder abuse, and we had to add protocols and language into contracts that prevented elder abuse, for example. And every state was very different. Okay. Now we're SEC registered. Okay. Now we are covered by a federal agency, and we are forever audited. We're audited by the SEC. It's one regulatory body that we have to deal with and adjust our processes for. And it's a lot easier to follow one versus a bunch of states, right? So very similar across a lot of different industries that are nationwide. And so if it becomes a patchwork of a regulatory environment, it's likely to become less efficient to do business in the United States. And so this is a good example of where, yes, red tape can be frustrating, but to try to do it in an uneven, moving, shifting playing field could be even worse. So don't think this is going to suddenly unlock huge profitability in the business world. Now, I'm Justin Klein. This completes another InvestTalk program. We thank you for listening. We encourage you to tell your friends and family about our free podcast downloads, which you can find anytime at iTunes, Spotify, or Google Play. And be sure to rate and review on iTunes as well. Independent thinking, shared success. This is InvestTalk. Good night. Hey everyone, if you enjoyed this video and want to see more amazing content, make sure you hit that subscribe button and turn on notifications.
Your support means the world to us and helps us create more videos that you love.
Subscribe now and join our community of savvy investors.